Hello, everyone. Jacob Shapar here with Zenith. Welcome to August monthly market update. We wish you are having a great summer. We took a pause in July. Hope you guys are enjoying your summer. With that pause, we have lots to cover. We have a full panel today. First, to introduce Pablo Marul, out currently in Buenos Aires. Pablo, welcome.
Hey, thank you, Jacob.
We have Nick King out in St. Louis.
Hey, Don.
And our guest for this month is Dave Fernandez, our advisor out in Springfield, Massachusetts, in the Boston area. Dave, welcome.
Thank you. It's good to be here.
Well, as you've seen, the volatility of the markets has been pretty persistent as the year has progressed. And we might have hit a potential window of time where that volatility may have softened. So we have lots to cover in regards to one of the major catalysts that has brought that volatility, which has been inflation, and how to tame that. So Nick will go over that. We'll go over some performance numbers in terms of indices, how we're doing, and historically how they've done. So hopefully we can find some clues as to how we finished for the year. We're going to tie things all up together with understanding what one should be doing and things that we have done for our clients during these volatile times to make sure that you get out ahead. Before I hand it off to Nick, I think it's so important to realize the time that we're in right now, these recessions, these bear markets, they really are the times where the wealth transfer effect takes place. People that stay disciplined, people that actually become more aggressive with their investing during these times where the majority of people are maybe a little bit timid, there's this wealth transfer that takes place. And that's obviously why we're here to remind you of that. With that being said, Nick, the major catalyst so far has been inflation. The Fed has lived up to its word so far. There's been some data that's come out that maybe might change the outlook for the rest of the year in terms of Fed actions. What can you tell us?
Certainly positive news with the most recent inflation readings. They came in below in terms of the expected readings, which was positive. The market rallied after that. You have other things lingering in the background. Just kind of first and foremost here, you see this debate going on with the White House and the media in terms of what actually is a recession, and also talking heads on TV. I'd say just to kind of tune that noise out. Look at what's behind the cover of the market. And what's behind the cover of the market is a lot of layoffs are happening. So whereas the market has been positive these past couple of weeks, we're cautiously optimistic. A lot of the big S&P 500 companies, as you can see on this chart here, have already had layoffs. I'm sure there's probably more to come, because rates are getting higher and that squeezes the balance sheets for these companies. They have to get leaner and meaner.
Fair to say that there's a big debate whether the flush out of the downward trend in the market potentially has come to a final resting place or close to it?
Always a debate, but right now there's not what we call a lot of risk parity. You're seeing bonds and stocks kind of move in the same direction. And there's usually a little bit more clarity when you have stocks moving up and bonds moving down or vice versa. And once that happens, you can generally have more confidence in terms of which direction the market's moving in. Yes, debate in terms of not getting caught up in it and making mistakes, which we see a lot of times with self-directed investors. That's where you need to trust your advisors, trust us in terms of helping you out. Those are the things, just a few of the things that we're looking at. Hopefully bullish ahead, but guarded on the downside as well too.
Absolutely. And Pablo, what can you tell us about in terms of performance, seasonality, where we stand? Just because the Fed is increasing rates doesn't necessarily mean it's always doom and gloom, right?
No, and basically what we will see, our viewers are going to see this graph. So we compare the performance from the main indices and sectors from the beginning of the year until June 17 of this year, which was the bottom. We will see if it's the real bottom, but so far the bottom of the year. So if you see in the first half of the year until June 17, you will see SPY is Standard & 500, QQQ is Nasdaq 100, IWM is small cap, and DIA is the Dow Jones. The first half until the bottom performed 29%, they lost money. Small cap the same, 24%, and the SPY around 23% down. The best performer was the Dow Jones. Since the bottom until August 8th, it has inverted. Now is QQQ at Nasdaq's 100 and a small cap are outperforming, and then the Dow Jones is underperforming relative to the Standard & Poor's 500. They have done 15% small cap and Nasdaq, and around 13% Standard & Poor's 500. When we go to sectors, we have consumer discretionary and tech, which underperform. They lost money like 26% and 31% a consumer discretionary. But the best performers were utilities and healthcare, which utility lost only 9%. But when from the bottom, the sectors that they are outperforming are now consumer discretionary and tech. And the one that they are underperforming relative to the Standard & Poor's 500 are healthcare, because utility is interesting, has been outperforming the Standard & Poor's 500.
Other way to think about this, which gives us a little bit more positive sentiment going into the second half of the year, and something that we referred all the way back in January, that we felt a lot more optimistic in terms of market returns in the second half opposed to the first half with the expected Fed hikes. It seems like there is that sign, as Pablo mentioned, that the growth-oriented companies that prospered greatly last year really were beat down so far until June 17th date, which for now is the bottom, and they have now prospered since then. Also, the second part to that was historically, yes, volatility comes into play when the Fed hikes rates, but when you look at things from the cycle itself, the market still ends up positive. A lot of action in between, obviously, but these short-term spurts should not cause anyone to panic. It's good to be diversified, we're allocated, knowing when to be tactical and not, which we'll finish off with understanding a few different things of what else we could do during these times from an individual standpoint to manage your assets. So again, we welcome in Dave Fernandez.
Thank you, Jacob. The goal is always to try and support our clients, and if we can, turn a negative into a positive. Periods like we've seen over the last 8 months obviously are never pleasant. Well, we don't know if the current bottom is the bottom. One of the two things that we can guarantee as advisors is that we will see another correction, we will see another bear market. It's just the natural course. So I thought it'd be good to discuss some things that you can do during these periods to really move the needle forward, that we do with our own clients to help provide that additional benefit. First of which I think is pretty straightforward. If you have cash that's on the sidelines, these are great times to put that to work. It's always good to stay disciplined, to not panic, to have a plan, assuming that these types of things will happen. Now, the next two things are specifically tax strategies. So it's always important, speak to your tax professional, speak to your advisor. Hopefully these two are talking to one another, so there's a unified strategy. The first is to harvest your losses, having the ability to harvest them when the market's low, essentially bank them for future use to offset future gains. The next is Roth conversion. Assuming you have a plan in place, that this is something that the professionals that you're hopefully working with have told you this is going to be a positive process for you. When the market's down, that is something that is definitely can be made a priority to move up. If you typically wait till the end of the year, simply because it allows you to convert assets and realize that gain after you've already converted to a Roth, and can potentially see that rebound as a tax-free event.
That's excellent. Not to get too technical, obviously, some of these things for our viewers that don't know, please reach out to us, www.zenithim.com. Send us an email. We'll be happy to walk you through some of these more advanced strategies. For clientele that maybe are still puzzled, rest assured, some of these things have been done for you. We can simplify them that much more next time we connect, so reach out to your respective advisor. With our time, the only thing that we'll finish off by saying is the consensus is starting to change. We're still cautious heading into the end of the year, but I think it is prudent to start to buy these dips, and that doesn't mean if you have cash go all in. I think it's a great opportunity if you have a longer timeline to invest and have these monies in the market. A lot of positive signs. Of course, there's still a lot of data that's going to come out. Not to say there's going to be some challenges throughout the rest of the year. Likely that the first half compared to the second half will not be as volatile, which we will take, of course, comparing the two. Gentlemen, thank you for coming on. To our clients, a special thank you. We will catch you for next month's update in September. Take care.